Okay, so now in this video, we're continuing our discussion of topic 958, not-for-profit entities, and subtopic 20, financially interrelated entities. And up until now, we've understood what types of entities would be called financially interrelated, and that was in the scope section here. And now we're still in the recognition section, where before, in the prior two videos, we discussed contributions received for a financially interrelated beneficiary, and then a recognition of interest in a financially interrelated entity. And now we're going to be talking equity transactions. Now, first, I want to remind us they have very specific terms for the types of entities in these transactions. If we remember from the prior sections, there will typically be a donor, which may be a corporation or an individual, and that donor pays money to a recipient entity, and that recipient entity is required to pay that money to a beneficiary. So we have three parties in these typical transactions. And so with that understanding, a transfer of assets to a recipient entity, that's the entity in the middle, is an equity transaction if all of the following conditions are present. And so the first condition would be that the resource provider, this is the one that transferred the assets to the recipient entity, if the resource provider specifies itself or its affiliate as the beneficiary. So if the resource provider is the last one in the chain here, and they transfer assets back up to the recipient entity or to an affiliate of itself, then that would be considered an equity transaction because it's essentially investing in the recipient entity. And as a second condition, the resource provider, this will be the one transferring assets to the recipient entity. The resource provider and the recipient entity are financially interrelated entities. And we've defined this back in the scope section in a prior video, so you can go back to that section to remind yourself of what this means. And the third condition would be that neither the resource provider, that's the one transferring assets to the recipient entity, neither the resource provider nor its affiliate expects payment of the transferred assets, although payment of investment return on the transferred assets may be expected. So we might think of this like if this resource provider is the beneficiary and they send assets up to the recipient entity and they don't expect the recipient entities to send that money back to them, then it would be considered an equity transaction. If the beneficiary sent the money up to the recipient entity and it wasn't considered permanently the recipient entities, then that would make it not seem like an equity transaction. It's more or less kind of a loan. So anyway, if all three of those conditions are met, then the transaction, it was an equity transaction. So what does that mean for our financial statements? Here in 5, 6, and 7, they describe each of these conditions and what type of journal entries should be made. So first, if the resource provider specifies itself as the beneficiary, this is the A right here. So that would mean that the beneficiary sent assets up to the recipient entity, and it's to be recorded as an equity transaction because of that. Then that means it needs to increase its interest in the net assets of the recipient entity. So it would record an asset with a name such as interest in net assets of recipient entity, and then it would credit the assets that it sends. And so this is kind of similar to the prior video that we saw, section 25.2, only in reverse, because this time it's the beneficiary that sent assets up to the recipient entity, and not necessarily the recipient entity that is obligated to send assets down to the beneficiary. Okay, so let's take a look at the second one. If the resource provider specifies an affiliate as beneficiary of the equity transaction, then the resource provider shall report an equity transaction as a separate line in its statement of activities, and the affiliate named as beneficiary shall report an interest in the net assets of the recipient entity. So what does that mean? So let's say the resource provider sends money to the recipient entity, but actually an affiliate of the resource provider is the beneficiary of that recipient entity. So the resource provider will record that as sort of an expense in its statement of activity. So it sent some assets up to the recipient entity and recorded an expense because the result of the operations of the recipient entity actually go to the beneficiary, which is not the resource provider. And that's why sort of an expense is recorded here. And so on the side of the affiliate, who's the beneficiary, then the affiliate needs to record an interest in the net assets of the recipient entity because those assets are implicitly intended for the beneficiary. And so finally, this one, number 25.7, gives the example. So the resource provider specifies itself or its affiliate as a beneficiary, but the conditions in B and C are not present. So in that case, A is present. Resource provider specifies itself as a beneficiary, but the resource provider and the recipient aren't financially interrelated entities, and the resource provider actually expects payment of those transferred assets to be returned to it. So in that case, it's not necessarily an equity transaction, and especially it's not between interrelated entities, so it's more or less a loan to the recipient entity. And that's why here it says that it should be accounted for as an asset by the resource provider and as a liability by the recipient entity. So basically, the resource provider loaned assets to the recipient entity, and the recipient entity reports liability.